Question 1. Indicate whether each of the following costs of a pencil manufacture would be classified as direct materials, direct labor, or manufacturing overhead. Depreciation on the pencil painting machinery. So that would be manufacturing overhead. Lead inserted into the pencils, part of the pencil, so that's direct material. Factory utilities. Factory utilities would be manufacturing overhead. Wages of the assembly line worker, direct labor. Salary of the supervisor would be manufacturing overhead, because we can't relate the salaries to any one product. Factory of the maintenance, machinery maintenance guy, same thing. These manufacturing overhead. Okay, wood, direct material, and the little rubber at the end of the pencil, direct material. Number 2, identify whether each of the following is classified as a product cost or a period cost. Now, product cost is one, it's either direct material, direct labor, or overhead that is part of the cost of the product. Direct labor, of course, is a product cost, PR. Direct materials also is a product cost, P. Factory utilities, anything to do with the factory, product cost. Repairs to office equipment, no, that's a period cost, that's outside. So anything in the office is a period cost. Property taxes on the factory building, product cost. Sales salary, though, would be period cost. 3. Chorus Company accumulates the following data concerning a mixed cost, using miles as the activity level. So we want the highest activity, which is January, and the lowest activity. And we want the cost. So the variable costs is equal to the change in cost over the change in activity. Now, the change in cost, $15,000, $12,000 would be $3,000. And the change in activity, this minus this, would be 2,500 miles. Therefore, the variable cost is $1.20 per mile. That's the variable. Now, to get the fixed costs, total costs equal fixed cost plus variable cost. Okay? So therefore, fixed cost equal total cost minus variable cost. So if I take the high, fixed cost at the high, the total cost is $15,000, and the variable cost would be 10,000 miles times $1.20 per mile, which is equal to 12,000. Therefore, the fixed cost is $3,000. If I took it at the low, all right, fixed cost equals total cost, which is 12,000, minus 7,500 times $1.20, which equals 3,000. So therefore, my formula is y plus a plus bx is equal to $3,000. I can predict, plus $1.20 times every mile that is driven. Question 4. Henning Company estimates the variable cost will be 60% of sales and fixed costs will total $2,040,000. Selling price is $10 and there's 600,000 units sold. Compute the break-even point. Well, to begin with, if we put sales at 100%, variable cost is 60%, therefore the contribution margin ratio is 40%. Now, if we have selling price of $10 per unit, therefore the variable cost would be 60% of that, or $6, therefore the contribution margin per unit would be 4. Now they want to know the break-even. Okay. Break-even in units is equal to the fixed cost, 2040000, divided by the contribution margin per unit, contribution margin per unit, which is equal to 2040000 divided by 4, which equals 510,000 units. Now, if they want the break-even in dollars, that's equal to 204,000 divided by the contribution margin ratio, which is equal to 204,000 divided by 0.4. And the answer would be $5,100,000. Now B part said, compute for us, please. The margin of safety is equal to the actual sales minus the break-even sales. Well, I know the break-even sales is this. The actual sales then is 600,000 units times times $10, sorry, minus $5,100,000 break-even, which will equal $90,000. So that's my margin of safety. Lastly, then, they want us to compute the not the break-even, the net income. Okay. Net income, sales equals 600 units times $10. Variable costs equals 600,000 units times $6. Contribution margin is the difference between these two, which would be 2,400,000. And the fixed cost, 2,040,000. Net income then would be equal to $360,000. Question 5. Quick Service has over 200 auto maintenance service outlets nationwide. It provides primarily two lines of services: oil changes and brake repair. Oil change related services represent 70% of its sales, and it provides a contribution margin ratio of 20%. Brake, the other product, repair, represents 30% of its sales and provides a 60% contribution margin ratio. The company's fixed costs are $12 million. That is $600,000 per service outlet. First of all, calculate the dollar amount of each type that the company must provide in sales in order to break even, that is zero profit. Okay, now what we need to begin with is the weighted average contribution margin, and if we're talking dollars, then it has to be the ratio, which is equal to oil being 70%, 0.7 times contribution margin of 0.2, plus brakes being 30% of the sales mix times the contribution margin ratio of 0.60, and that equals 0.32. So therefore, if I want to break even in dollars for both products, it's going to be the fixed costs which is 12 million, divided by 0.32. And that would be 37,500,000 dollars. Now that's the break even for both products. So now I have to go to oil. Oil is 70%, so therefore the amount of oil sales, 37,500,000 times 70%. And brakes is equal to 37,500,000 divided by 0.30. So the answer is 26,250,000 of oil changes they have to sell, and 11,250,000 of brake repairs. Now the second part of the question says, okay, how much do I have to sell for each unit to make a profit? Well, the sales required is equal to the fixed cost plus target income over the contribution margin ratio. So each unit, each outlet sells both oil and brake repairs, but the fixed cost for each outlet is 40,000. Oh, I'm sorry, the fixed cost is 60,000. The target net income is 40,000. And the contribution margin ratio, as we calculated before, is 0.32. So therefore, the total amount of sales we have to do is 312,500. That's the total for both. So oil would be 370% of the 312,500. And brakes would be, this is times 70%, 312,500 times 30%. So therefore, the amount of oil change, the revenue they have to get in oil change is 218,750 in sales, and sales of brake repairs have to be 93,750. If each outlet achieves those sales figures, they will earn a profit of 40,000. The cost, volume, profit income statement shown below for Hoffman and Tolan. And you can see they're making the same sales revenue, 600,000, and they have the same profit, but they have a different cost structure. Variable cost 280 for Hoffman, 80 for Tolan. Fixed cost 170 for Hoffman, 370 for Tolan. So they have a different mix of fixed and variable. First of all, they want the degree of operating leverage. Well, for Hoff, that is the contribution margin divided by net income. Net income, which equals 320 divided by 170